In my last video, I showed you that the Nasdaq 100 turned $1 million into $15.2 million over 26 years. Incredible returns, but the ride included an 83% crash. $1 million dropped to $170,000. Now, what if I told you there's a portfolio that turned the same 1 million into 18.9 million? That's $3.8 million more than going all in on the Nasdaq 100, while cutting the worst crash from 83% down to 34%. More money, less pain. Sounds too good to be true, right? In finance, higher returns usually come with higher risk, but the right combination of assets can push that trade-off in your favor, and I have 26 years of real data to show you how. Welcome to Alpha's Backtest Lab. I'm Uncle Alpha. Quick note, everything here is for educational purposes only. I'm not a financial advisor and nothing in this video is investment advice. All investments carry risk. Always do your own research. But here's what surprised me most. The biggest difference between these two portfolios isn't the returns, and it isn't the drawdowns. It's something most investors never think to calculate. And once you see it, you never look at a backtest the same way again. Today, I'll break down exactly what's in this portfolio, why this specific ratio, and how it survived 3 major crashes across 26 years of data. Let me paint you a picture of what an 83% crash actually feels like. It's March 2000. You have $1 million in QQQ. The Nasdaq has been ripping higher for years. You feel smart. 6 months later, your account shows 700,000. You tell yourself it's just a pullback. It'll bounce back. 1 year in, 500,000. You start losing sleep. You check your account before breakfast, after dinner, at 2 a.m. 18 months, 300,000. You've lost more than most people earn in a decade. Your spouse is asking questions. Your stomach hurts. 2.5 years in, 170,000. You've watched 83 cents of every dollar evaporate. And here's the worst part. You wouldn't recover for another 12 years. The total round trip took over 14 years. This isn't hypothetical. This is exactly what happened to QQQ between March 2000 and January 2015. Now here's what behavioral finance research tells us about human behavior during crashes. When your portfolio drops 25%, about 80% of retail investors sell. At minus 35%, that number jumps to 95%. And the percentage who can hold through an 80% drawdown? Less than 1%. This is why the stated return on a fund's fact sheet is almost meaningless. A gym membership you never use doesn't make you fit. A return you can't hold doesn't make you rich. What matters is the return you can realistically keep. I use a metric I call the Keepable Return Score, KRS for short. Your annual return times the probability you actually stay invested long enough to collect it. It's not a percentage, it's a score, like the Sharpe ratio. The higher the number, the more return you can realistically capture. Think of 2 roads heading to a similar destination. QQQ's road has no guardrails, and a cliff where 99 out of 100 drivers go over the edge before they arrive. The 3-asset road has guardrails. Same storms, same weather, but 6 times more drivers actually reach the end. QQQ, 10.85 times 0.05 survival equals a KRS of 0.54. 3-asset, 11.79 times 0.30 equals 3.54. 6.5 times higher KRS. Not because the portfolio is magic, but because you're 6.5 times more likely to actually hold it. So what's in this portfolio? 48% S&P 500, that's SPY. 12% Nasdaq 100, QQQ. And 40% gold. 3 assets, 1 rule, rebalance once a year. That's the entire strategy. I backtested this portfolio from 1999 through 2025. 26 years covering the dot-com crash, the financial crisis, COVID, and the 2022 rate hikes. Every major type of market disaster in modern history. Now, 40% gold might sound like a lot. Let me show you why the math demands it. The best way to judge a portfolio isn't during good times, it's during the worst times. So let's stress test this portfolio across 3 real market crashes. Remember that 83% crash I just walked you through? Here's what each strategy did during that same period. QQQ lost 83%. SPY lost 45%. The 3-asset portfolio down 32.64%. On a $1 million portfolio, that's the difference between having 170,000 left or 673,000. And recovery? QQQ took over 14 years to get back to even. The 3-asset portfolio? About 4.5 years, a decade less time spent underwater. This one was different. In 2008, everything fell. Stocks, real estate, corporate bonds all crashed together. This was the 3-asset portfolio's worst moment in 26 years. QQQ dropped 53%. SPY dropped 53%. Almost identical because the entire market was collapsing. The 3-asset portfolio down 33.92%. That's its all-time worst, and it still held on to 2/3 of its value. Why the difference? Gold. But not in the way you might think. Gold wasn't a smooth ride either. Early in the crisis, gold and stocks moved in opposite directions. Gold climbed while QQQ was already falling. Then panic spread to every asset class, and gold dropped sharply too. But here's the key. Gold recovered. By the end of the crisis, gold finished up 25%, while QQQ was still down over 50%. That different rhythm is exactly why the 3-asset portfolio held up. Gold didn't need to be a perfect hedge. It just needed to zig when stocks zagged. This is what a near-zero correlation actually looks like in a real crisis. Not gold always goes up when stocks go down, but gold moves to a different beat, and over time, that difference saves you. The Fed raised interest rates from near zero to 4.5%. Tech stocks got crushed. QQQ dropped 34%. SPY dropped 23%. The 3-asset portfolio? Just 18.5%. On a $1 million portfolio, that's the difference between losing $340,000 versus $185,000. The 3-asset portfolio had $155,000 more still in the account, ready to compound when the 2023 rebound hit. You can't compound what you've already lost. Nobel laureate Harry Markowitz called diversification the only free lunch in investing. This 3-asset portfolio is the mathematical proof. More return than QQQ, more return than SPY, and dramatically less pain across 3 very different types of crashes over 26 years. Let's talk about why this specific mix works. It all comes down to one number, correlation. Correlation measures how closely 2 investments move together. Think of it like dance partners. Some always move in sync, others dance to completely different songs. SPY and QQQ have a correlation of 0.98. That's almost perfect synchronization. When one falls, the other falls with it. Holding both doesn't give you much protection. But gold and stocks? The correlation is negative 0.004. Essentially zero. When stocks crash, gold doesn't care. It's dancing to a completely different song. That near zero correlation is the entire foundation of this portfolio. It's why 40% gold, which might feel like a lot, is actually the mathematically optimal shock absorber. This is the most common objection, and in this 26-year window, the data says the opposite. gold returned 11.34% annually, actually higher than the S&P 500's 10.63%. Gold isn't just a safety net. In this period, it was also a strong performer. I didn't pick 48/12/40 by feel. I wrote a Python optimization program that tested thousands of possible allocations across the full 26-year dataset. The math consistently pointed to this neighborhood. The key insight: you want enough stocks for growth, enough gold for crash protection, and the right balance between SPY and QQQ. Too much QQQ adds volatility without enough extra return. Too little gold weakens your shock absorber. Here's where it gets really interesting. Without rebalancing, just buy and hold. This same portfolio earned 10.16% annually. 1 million became 12.9 million. With annual rebalancing, it earned 11.79%. 1 million became 19 million. That 1.63% annual difference compounded into $6 million extra dollars. Why does rebalancing add so much? Because it forces you to do what's hardest: sell the winners and buy the losers, systematically, once a year. Think of it as an autopilot that sells high and buys low. Every January, you trim whatever went up the most and add to whatever fell behind. Over 26 years and 26 rebalancing events, that discipline compounds powerfully. And here's what surprised me. Annual rebalancing didn't just save on trading costs. It actually had the lowest maximum drawdown of any frequency I tested. Monthly and quarterly rebalancing had deeper drawdowns, over 35%, compared to annual at 33.92%. Less frequent rebalancing was actually safer, with the higher Sharpe ratio and lowest costs. In this backtest, the portfolio rebalances once a year, every January, back to 48/12/40. No judgment calls, no market timing, no threshold decisions. Just restore the target. One adjustment per year, that's the entire system. The Sharpe ratio, think of it as miles per gallon for your portfolio, tells the whole story. The free asset portfolio scores 0.69 compared to QQQ's 0.29, more than double the fuel efficiency. Now let me be honest about what this portfolio can't do. This is not a zero-risk portfolio. The worst drawdown was 33.92% in 2008. That means 1 million dropped to 660,000. Behavioral research says 95% of investors would sell at minus 35%. This portfolio sits right at that edge. Gold returned 11.34% over these 26 years. But this period was exceptionally favorable. Massive monetary expansion, multiple financial crises, and rising geopolitical tension all pushed gold higher. A different era, say decades of stable growth and low inflation, could change gold's performance significantly. The portfolio's real insurance policy isn't gold's return, it's gold's near zero correlation with stocks. As long as that relationship holds, the diversification benefit works even if gold earns less. The longest drawdown lasted 1,680 days, that's about 4.5 years underwater. Better than QQQ's 14 years, but still a long time. If an investor is within 5 years of retirement and a crash hits, this recovery timeline could be a problem. QQQ, $15.2 million. Free asset portfolio, $18.9 million. 3.8 million more, with less than half the pain. And when we factor in the human element, the probability an investor actually holds on, QQQ KRS 0.54, free asset KRS 3.54, 6.5 times higher. The return an investor can actually keep, that's the only return that matters. This portfolio's worst drop was 34%. For some investors, that's completely manageable. For others, it's still too much. There's no right answer. It depends on individual circumstances. But what if we could cut that pain in half? In my next video, I'll add one more asset class to the mix and show how a 4-asset portfolio kept the maximum drawdown under 18% with a Sharpe ratio of 1.14. That's the next episode of Alpha's Backtest Lab. If these data change how you think about portfolio construction, hit subscribe. I publish one data-driven deep dive every week. Remember, no framework is perfect. Past data doesn't guarantee future results. Use these tools as a starting point for your own research, not as the final answer. I'm Uncle Alpha. I'll see you in the next one.